Okay, it's been the hot topic, varying opinions, but the 50-year mortgage, also portable mortgages, interesting stuff. We're going to talk about that today. Also, you might be surprised what the average age of the home seller is, and it shows how long they've been staying put in their home. So we're going to talk about that today and how it could affect the housing market. Let's get into it. So you've probably heard Trump proposes a 50-year mortgage to help affordability. And this is pretty interesting, right? Because on its face, it's like, well, that's great if we could make the monthly payments more affordable. But let's talk about everything else that happens with that. So first of all, the amount of interest that you're paying over 50 years, holy cannoli, that's not great. Also, the amount of principal that you're paying over that time, very minimal. So it doesn't allow people to have a lot of equity. This is saying Trump on Saturday posted an image on social media that seemed to suggest he'd be proposing 50-year mortgages. This is from last week, by the way, this article. So that they're referencing a couple Saturdays ago. The president has been focused on the issue of housing affordability through his term, leading off the inauguration day with an executive order for emergency price relief in housing. He's also pressured the Fed to lower interest rates. We've been following all of that. And so now this proposal of a 50-year mortgage, a longer fixed rate amortization on mortgage loans would lower monthly payments using Fannie Mae's mortgage loan calculator with a 20% down payment and mortgage rate of 6.575. The breakdown below shows payments at different home prices and mortgage terms. So you can see here for a $300,000 house and a 30-year fixed payment, you're about $1,529 a month, and that's principal and interest. So that's kind of what we're seeing today if you're finding a home for $300,000. Now, if we go to a 50-year fixed, it'd be $1,366. So you are saving almost $200 a month. However, how much of that money is actually going towards the principal? Very little. Even if we jump to a $500,000 house, which is a more realistic price in the Phoenix metro area, 2548 at a 30-year fixed, 2277. So, almost $300 savings there a month. Again, though, the same problem persists that, it's making it more affordable on that monthly payment, but what are the repercussions of that? So according to Logan Motoshami, who I follow and have talked about a lot on this channel, he says, I understand that we have a housing affordability challenge in America, but subsidizing more demand from 30 to 50-year mortgages is not the policy we want to take now. Housing has to balance itself out through slowing home price growth and wages increasing, as it has for many decades. To add another subsidization to the market just prevents the healing process from occurring, which also prevents less equity build out as well. I'm not a fan of increasing in the amortization. The 30-year fixed is perfectly fine as is. It's also illegal right now for a 50-year mortgage under the qualified mortgage law. So all of that would have to change. So it's not something that is going to happen overnight. If it happens at all, from what I've been looking at and seeing out there, there is a lot of naysayers on this. This article says, how much would a 50-year mortgage cost homebuyers? The longer loan term means higher rate and more interest paid over the life of the loan. Another question that I would have around this too is, would this, freeze our housing market even more because people potentially would stay in their homes longer if they have a longer mortgage? I don't know, just a thought. This is kind of breaking down that same type of, monthly payment that we were looking at on the past article. However, this one actually breaks down the total interest paid over the life of the loan. So for a $300,000 house over 30 years, you're paying $369,000 in interest. So that is kind of as it stands today with a 30-year fix, but a 50-year fixed loan, $755,000 in interest paid over 50 years when the loan amount is $300,000. So that is a huge difference in the amount of interest that you're paying. Also, the monthly principal that you're actually putting towards the house is less in this scenario, so you don't have as much equity as time goes on. You can see here the difference with $400,000, $500,000, which gets kind of astronomical in terms of interest. Now, do most people, would they spend the full 50 years paying off this loan? Probably not. But if you did, that amount of interest is just kind of wild to comprehend. So, like I mentioned, 50 years in the same mortgage. Does that mean people won't move as often? Well, that brings me to the next solution they're possibly talking about, portable mortgages. So it is exactly what it sounds like. You take your mortgage with you. So they're actively evaluating this. They say that just over half of homeowners with a mortgage have a rate below 4%, according to Redfin. However, average mortgage rates have remained stubbornly stuck between 6 and 7%. We all know this. And homeowners who are locked into ultra low mortgage rates have been less willing to move and potentially pay hundreds more in interest each month on new mortgages at the current rate. So if you allow people to keep their lower mortgage rates and encourage them to move and free up supply, I don't know if that's as much of an issue now personally. Like, I feel like the lock-in effect has started to ease. We've talked about that on this channel. People are moving if they need to move, and if they don't need to move, then maybe they stay. But the mortgage rate isn't the only thing keeping them in their home. Plus, it's not like our supply is super restricted. We have enough movement in the market right now. At least I'm talking about, Phoenix Metro. Nationally, there are some areas that are probably a little bit more locked in, have lower inventory, but for what's going on here, I don't know that we need to, stimulate the housing market by offering portable mortgages. So they say, imagine a homeowner selling their house for $400,000 with half of that paid off on a 3% mortgage. With a portable mortgage, they could sell their home and transfer the $200,000 left on the loan to a new house, keeping the 3% rate. Now, if they are upsizing, right? If the house is more expensive, it costs $450,000. For example, the buyer would need to cover the extra $50,000 either in cash or through a second smaller loan, likely issued at the current higher interest rate. The hope is that homeowners could move without losing their low rates. More homes will go up for sale, giving buyers who've been locked out a better shot. Now, also, something to consider, I don't think that, mortgage lenders are going to love this idea, because how are they going to, continue to make money if they're not issuing new loans, right? We got to think about that. They also say that this would disrupt mortgage-backed securities. Those are bundles of mortgages that banks or lenders sell to investors, which gives the banks the cash they need to issue new loans and help keep the mortgage market flowing. If a homeowner can take their loan with them, then obviously fewer loans will be paid off early, more risk for investors who might demand higher interest rates to compensate. So, honestly, even if we did come up with a portable mortgage idea, it's not going to be as black and white as it is today, right? There's going to have to be a higher cost involved in having that type of convenience, whether that's in the rate or fees that you pay, something like that. But I am curious to know what you guys think about this. Put it in the comments. What do you think about a 50-year mortgage? What do you think about a portable mortgage? Would this help or hurt the housing market? As a buyer or seller, what do you think about that? So let's talk about rates. Rates on the rise Friday, now near 2-month highs. So we saw some really great movement in rates. Rates have gone back up, but you know what? They're not really even that high. We're sitting at 6.38 on this graph. It looks pretty dramatic, but we're still below 6.5 and well below 7 at 6.38. So now that the government's reopening, there's some economic reports that are going to be coming out, which could really affect what's going on in the market, affect the decision from the Fed, because they said they were going to cut rates in December. They may not be doing that. And so with that said, the markets have kind of pulled back, which has affected the mortgage rate going up a little bit higher. But again, 6.38 is not the end of the world compared to what we have been seeing. Now, if you've been considering buying and you're going to be getting a mortgage, now you know kind of generally where those rates are. If you just kind of want to know what your affordability could look like, check the description below. I have a link to a mortgage calculator. I also have a link to homes with assumable loans if you want to check that out. Another way to get lower rates is buying a home that has an assumable mortgage. I can give you more information about that on a discovery call with our team. So check the description below if you'd like to schedule a free discovery call with us. Now, you might might be surprised to see the age of the average home seller. I wouldn't have guessed this number. I would have thought it's maybe a little bit younger, but it makes sense as to why our supply has been a little bit restricted. Before we get there, if any of this is helpful for you, consider subscribing to join our community and get market updates, especially for here in Phoenix moving forward. So the typical home seller is now 64. I didn't expect that. They're staying put longer than ever. So this article is referencing the National Association of Realtors 2025 profile of home buyers and sellers. They're saying the typical seller is now 64 years old, has owned their home for a median of 11 years, both the highest figures on record. In 2005, the average seller was just 47. So that's like a almost 20-year difference. Data from the National Association of Realtors report shows that the same trend in home buyers, the typical first-time home buyer age, is up to a record 40 years old, while the age of the home buyers as a whole reached a record of 59. The typical repeat buyer is now 62, which is also an all-time high. So why do we care about this? Well, when sellers are older and holding onto their homes for longer, obviously inventory is going to be a little bit tighter. Buyer competition can increase. So I found this interesting because I wouldn't have guessed 64 is the average, but that obviously goes to show that homeowners are holding onto their homes for longer than they have in the past. Now, is that due to affordability? Possibly. Is it because they have a lot of equity and they don't want to cash out just yet if they don't have to? There's probably a number of factors that are influencing that, but the bottom line is that tightens our inventory. So speaking of inventory, where are we at here in Phoenix Metro? Let's take a look at the Cromford Market Index. This gives us a really good gauge on what's going on throughout the valley. Our supply index is at 104.9, which means we're 4.9% above normal for supply. And we haven't taken a look at active listings in a bit, so I wanted to pull that up and see where we're at, about 25,684 today. You can see 2024 is the teal line here. And isn't it interesting that it appears that we are about to follow the same trend as we did in 2024, meaning that inventory is going to start to decline. It looks like we're kind of making that turn right now. We'll see if that continues the rest of the year, but very typical for the end of the year. We don't see as many new listings coming to market. People are distracted with the holidays. They're waiting till the new year, so on and so forth. And so we may be starting to see that inventory dwindle at this point. Now, where we're at with demand, we're still about 18% below normal with demand. That hasn't changed all that much. So the overall market index, 78.4, anything below 90, according to the Cromford Market Index, is considered a buyer's market. So we're definitely in a buyer's market across the major Metro Phoenix area. Every city can be a little bit different. So let's take a look at what that looks like. We've got a mix of green and red arrows. So anything above 110 is considered a seller's market. You can see Cave Creek to Fountain Hills is experiencing that. Phoenix down to about Glendale is a balanced market. Peoria all the way to Maricopa, there is considered a buyer's market. Some of these cities are shifting more towards a buyer's market and some more towards a seller's market. But overall, the average change amongst these cities month to month was only negative 0.6%. And the prior week, I think we were at negative 0.21%. So the trend towards a buyer's market has slowed down, although it's not really, accelerating one way or the other too quickly. So not a change that you'll be able to notice as a buyer or seller in the market. But I think a lot of this is due to inventory decreasing. Demand isn't going up at the moment, and the change in the market month over month has kind of slowed down. I also wanted to take a look at where we're at with the contract ratio. The green color is a balanced warm market. The blue color is a cold market. We kind of have a mix of all of that. You can see a lot of the outer edges of the city are in this balanced warm. And then there's a few zip codes throughout central Phoenix, throughout the West Valley that are leaning a little bit more towards that cold market. Actually, as we get down to, Casa Grande and Maricopa, those are also in that area as well. But we're just really not seeing anything that is, warmer and hot. There's not a lot of, or really any yellow or even red at this point. So we'll keep an eye on this and see how this continues to trend. I want to hear from you guys what you think about the 50-year mortgage, the portable mortgage, and if you have any interest in assumable mortgages, check the description below for more information. I'll be back next week with another market update.